Did you just watch your silver investment get cut nearly in half and have absolutely no idea why? Comment below right now and tell me, where in the world are you watching this from? I want to know because what happened to silver over the past 18 months did not just affect one country, one region, or one type of investor. It shook every continent, rattled every exchange, and humbled virtually every analyst who thought they understood this market. And if you are confused, frustrated, or quietly terrified right now, you are in extraordinarily good company. Let us begin with a confession of sorts. Markets, in their most theatrical moments, have a way of making fools of the confident and geniuses of the patient. Silver, from January 2025 through this very week of June 2026, has staged perhaps the most audacious, most disorienting, and most ruthlessly instructive performance any commodity market has delivered in the modern financial era. And the numbers, the cold, unsparing numbers, tell a story so extreme that if you encountered it in a novel, you would dismiss it as melodrama. Cast your mind back to January 2025. Silver opens the year at $29.50 per ounce. Not $129, not $129.50, $29.50, zero. $29.50. A number so unassuming, so thoroughly unremarkable, that the financial press could not be bothered to notice it. Cryptocurrency was consuming all available oxygen. Technology stocks were the obsession. And silver, that ancient, industrial, perpetually underestimated metal, was grinding quietly in the background, ignored by everyone who considered themselves sophisticated. But here is what the sophisticated observers were missing. And this is perhaps the most important educational observation in this entire discussion. Underneath the surface of that unremarkable 29.50 price, something structural was building that had nothing to do with sentiment, speculation, or social media enthusiasm. The Silver Institute was compiling data that would eventually confirm the silver market was entering its fifth consecutive year of supply deficits, meaning total global demand was exceeding total global new supply. Mining companies were quietly reporting declining ore grades. Industrial users, the manufacturers of solar panels, electric vehicles, and artificial intelligence infrastructure, were beginning to notice that the metal they needed was becoming genuinely harder to source. These were not whispered rumors. They were documented, verifiable, unglamorous facts that most market participants were too distracted to read. Through January and February of 2025, silver did what boring assets do in boring times. It crept. A few cents gained here, a dollar added there. By late March, it had reached $34.40. Still no headlines. Still no breathless television segments. By the spring and summer of 2025, the grinding continued, and then September arrived and something shifted. Analysts who watched these markets with the patience of geologists began describing the buying pressure differently. They called it conviction. That specific technical word means something precise in this context. The upward movement was not speculative froth being blown in on a warm wind. It was sustained, deliberate, and rooted in something real. By late September 2025, silver was approaching $41. And then October 2025 produced the moment that, in retrospect, divided the entire story into a before and an after. On October 15, 2025, silver broke above $54 per ounce, shattering an all-time high that had stood for 45 years since 1980. 45 years. Think about what that means in human terms. An investor who had watched silver peak in 1980 was now watching their grandchildren witness its successor. The price ceiling that had defined an entire generation of commodity trading was gone. Silver was now in what market analysts call price discovery territory, a genuinely uncharted landscape without historical reference points above. The market pulled back, as markets always do after such moments. Silver retested the $47 support level in November 2025, precisely the kind of normal, healthy consolidation that students of commodity markets study in textbooks. A second peak at $53.26 on November 11th, another measured retreat. And then December came roaring in. A fresh all-time high near $58.50 on December 1st. Momentum building with the accumulating force of something that has been compressed too long. And when December 31st, 2025 arrived, and the final arithmetic was performed, the number was staggering. Silver had gained approximately 147% for the calendar year, from $29.50 to $74.20 in 12 months. 147%. in a single year. Now, and this is genuinely important as a matter of behavioral finance education, consider what that number did to the psychology of observers. Studies of investor behavior in commodity markets reveal a consistent and painful pattern. In rapidly rising markets, many retail participants delay engagement. They wait for a pullback that never arrives at the magnitude they expect. They convince themselves the move is overdone. They stand at the platform watching train after train depart. And they console themselves with the thought that surely, the next correction will be deep enough to justify entry. Silver in 2025 documented this pattern with almost clinical precision. Those who were waiting at $35 for a return to $29 watched it reach $74. Those waiting at $50 for a return to $42 watched it close the year above $74. The behavioral economists have a name for this paralysis. It is simply and humblingly human. But the truly astonishing chapter had not yet been written. Because January 2026 was about to deliver something that no living person had ever witnessed in the entire recorded history of silver trading. Silver opened 2026 at $74.02 per ounce, a number that, just 12 months prior, would have seemed hallucinatory. And yet, against the backdrop of what was about to happen, $74 would soon look like a quiet, almost nostalgic starting point. In the first 14 days of January 2026, the momentum was unlike anything the silver market had experienced in the modern era. On January 14th, silver surged to a new all-time high of $92.20, a 25% move in less than 2 weeks. And as the price approached what every market participant on Earth recognized as the most psychologically loaded threshold in the history of this commodity, something extraordinary happened to global sentiment. The number was $100. And in the architecture of human psychology, round numbers are not merely convenient, they are gravitational. Behavioral economists have documented extensively that market participants assign disproportionate significance to round figures. They function as cognitive anchors, as finishing lines, as symbolic declarations about what is possible and what has never been possible before. And $100 silver had never been possible before. Not once. Not in the 1970s bull market, not in 2011, not ever, in the entire recorded history of this metal as a traded commodity. On January 26, 2026, silver surged past $100 and kept going, reaching $116.67 in a single extraordinary session. Social media platforms erupted. Retail trading platforms reported silver order volumes multiplying at rates their systems were barely designed to handle. Buying interest from Asia, Europe, and the Americas intensified simultaneously. And 3 days later, on January 29, 2026, silver reached its absolute all-time recorded peak of $121.62 per ounce, the highest nominal price in the entire history of silver as a traded commodity. The physical data supporting that move was not hypothetical. Registered silver inventories at the COMEX fell approximately 31% in a single quarter in early 2026. More than 33 million ounces were physically withdrawn from COMEX vaults in January 2026 alone. Real metal, real warehouses, real shortage. Now, if you are finding the story genuinely educational, if you feel like you are finally understanding what actually happened and why, this is the moment to hit that subscribe button, because the second half of this story is where the lesson gets its sharpest edge. What comes next is the part that nobody who lived through it will ever entirely forget. On January 30th, 2026, the day after the all-time high, silver crashed 35% in a single trading session, from $121 to approximately $71 in a matter of hours. Weeks of accumulated gains dissolved in an afternoon. And the question that every serious student of financial markets must answer is not whether silver is good or bad, not whether the bull market was real or illusory, but rather, what mechanical forces caused this to happen? Because understanding the mechanism is the entire lesson. 3 forces struck simultaneously, and their convergence was not a matter of silver's fundamental value changing. The first was the nomination of Kevin Warsh to lead the Federal Reserve. Markets perceived Warsh as significantly more hawkish, more inclined to maintain or raise interest rates than previous leadership. And when interest rate expectations shift abruptly, markets mathematically reprice all rate-sensitive assets, including precious metals, because higher rates increase what economists call the opportunity cost of holding non-yielding assets. Silver pays no dividend, it generates no coupon. When you can earn meaningful yield by simply holding cash or bonds, the arithmetic of holding silver changes. The second force was perhaps the most mechanically decisive. The CME Group, which operates the exchange where silver futures contracts are traded, raised initial margin requirements for silver futures to 15%. In plain educational terms, anyone who had used borrowed money to control silver futures positions was suddenly required to post additional collateral immediately, or be compelled to liquidate their positions regardless of their own assessment of value. This is a margin call, and its effects on markets are not subtle. It transforms what might otherwise be a manageable 10% to 15% correction into something that looks like a market in cardiac arrest, because sellers are not choosing to sell based on any rational evaluation of silver's worth. They are being mechanically forced to sell by their brokers at whatever price the market will bear. This precise mechanism, forced margin liquidation, is what turned a correction into a catastrophe. The third force was simple arithmetic applied to human nature. After a 147% annual gain in 2025, followed by another 64% surge in the first 4 weeks of 2026, a substantial portion of participants had accumulated profits so large that the sight of weakness was all the trigger they needed. Profit-taking at scale is indistinguishable from panic at scale when it all happens at once. By February 2, 2026, silver had fallen to $71. Through February and March, every recovery attempt was sold into. Technical analysts described what followed as a pattern of lower highs and lower lows, the clinical vocabulary of a downtrend. A second major sell-off hit in late March 2026, driven by continued Federal Reserve policy uncertainty and dollar strength. By late March, silver settled into the upper 60s. And today, Thursday, June 11, 2026, silver is trading at approximately $64 per ounce, down nearly 47% from its January 29 all-time high, and sitting near 11-week lows following renewed geopolitical tension from U.S. military strikes against Iran, which has disrupted energy flows through the Persian Gulf and amplified inflation concerns. 47% below the high. And yet, and here is where historical literacy becomes genuinely valuable, still more than 110% above where silver traded just 18 months ago. That simultaneous reality, crash and triumph existing in the same number, is precisely what makes commodity markets so relentlessly humbling and so endlessly educational. History, as the saying goes, does not repeat, but it rhymes with a precision that ought to give us pause. And the rhymes in silver's current situation are worth examining with some care, because they complicate the simple narratives that emotional market commentary tends to offer. In the 1970s, the most extensively studied precious metals bull market in modern history, silver rallied powerfully from roughly $1.29 per ounce in 1970, and then in 1974 experienced a correction of approximately 45%, a correction that, to observers living through it, felt like the definitive end of everything. The documented historical record shows it was not the end. Silver went on to gain more than 38 times from its 1970 starting price, eventually reaching $49.95 by 1980. A 45% correction that looked terminal proved to be an intermission. In 2011, the last major silver bull market before this one, silver ran from approximately $9 to $48, and then crashed with mechanically identical fingerprints to February 2026. CME Group margin requirement increases, forcing leveraged sellers to liquidate, a sudden, violent, disorienting collapse that preceded years of price stagnation. The 2011 situation differed from 2026 in one crucial respect, according to analysts who have studied both episodes. In 2011, the fundamental backdrop for silver changed after the crash. Industrial demand growth slowed. Above-ground inventories remained relatively ample. Monetary policy was tightening with real consequence. The analytical question, and it must be stated clearly as a question, not an answer, is whether those specific conditions exist today. The Silver Institute has confirmed that the silver market is heading into its 6th consecutive year of supply deficits. The cumulative 5-year deficit through 2025 reached an estimated 820 million ounces, roughly equivalent to an entire year of global mine production. Industrial demand from solar panels, electric vehicles, and artificial intelligence infrastructure is documented and growing. Mine production has remained essentially flat at around 813 million ounces annually, with ore grades declining and new project pipelines thin. Approximately 70% of silver is mined as a byproduct of other metals, meaning output cannot simply respond to price signals the way primary commodities can. The supply story has not changed because of what happened on January 30th, 2026. What do institutional research organizations say about where silver goes from here? JP Morgan's revised 2026 forecast, published in February of this year, projects silver to average $81 per ounce for the full year, with the fourth quarter expected to reach $85 as its highest quarterly average. The bank describes this as a picture of a higher floor for silver, attributing the expected level to tight supply and strong demand, while acknowledging that the ceiling remains genuinely unclear. Bank of America's metals research team, led by Michael Widmer, has published a range of $135 to $309 per ounce for 2026's bull case, based on gold-to-silver ratio compression and physical supply constraints. Long-term analyst consensus for 2030 clusters in the range of $180 to $220 per ounce, though the range of serious institutional forecasts for silver is extraordinarily wide, from $44 to $165 for 2026 alone, which itself is a piece of information. When sophisticated analysts disagree that dramatically, it tells you something honest about the genuine uncertainty that exists. What are the risks? They are real, and they deserve equal billing. If speculative positioning in silver continues to unwind before physical market tightness reasserts itself, silver could test lower levels, with some cautious institutional voices pointing to the $55 to $65 range as possible support before stabilization. If the global economy enters recession, industrial demand, which constitutes roughly 55% to 60% of total silver consumption, would contract meaningfully as manufacturing activity slows. Technological research into reducing silver content in solar panels is ongoing, and commercially viable substitutes, if they reach mass production, could meaningfully reduce that demand driver over time. And the geopolitical situation, the ongoing conflict in the Middle East, the closure of the Strait of Hormuz disrupting energy flows, the inflation concerns that have already pushed precious metals to 11-week lows this week, represents a category of uncertainty that no model adequately captures. The Federal Reserve meeting on June 16th and 17th looms as the next significant inflection point. The CPI data released yesterday, June 10th, and the PPI data released today, June 11th, are critical inputs into what the Fed might signal. Analysts have noted in their published research that any indication of rate reductions in the second half of 2026 could trigger a sharp response in precious metals. But predictions about policy reactions are inherently uncertain, and actual outcomes, as anyone who has watched markets for more than a week will confirm, frequently confound the most confident expectations. What, then, is the educational synthesis of this entire extraordinary episode? It is this. From January 2025 through today, June 11th, 2026, the silver market has provided a compressed masterclass in how commodity markets actually function, not as they are described in introductory textbooks, but as they truly behave in the presence of structural deficits, speculative positioning, margin mechanics, behavioral psychology, and policy shocks. The climb from 29.50 to 121.62, the single-day 35% collapse, the grinding recovery and subsequent decline to $64, these were not anomalies. They were the market doing precisely what markets do when extraordinary forces converge. The conditions that historically ended the 1980 and 2011 silver bull markets, deeply positive real interest rates, easing supply deficits, slowing industrial demand, are not confirmed to be present in June 2026. Whether they materialize in the months ahead is genuinely unknown and unknowable with certainty. Anyone who tells you otherwise is mistaking confidence for knowledge. The most financially literate response to this moment is not certainty in either direction. It is the kind of informed, patient, intellectually honest uncertainty that comes from understanding the full story, the fundamentals, the mechanics, the psychology, the history, and the risks, and then making whatever decision is appropriate for your own specific situation, with your own risk tolerance, your own timeline, and your own qualified financial professional at your side. If this discussion has shifted your perspective even slightly, if you now understand silver's journey in a way you did not before, drop a comment below and tell me specifically which chapter of this story surprised you most. Was it the margin mechanics behind the crash? The historical precedents from 1974 and 2011? The institutional forecast range that runs from $44 to $309 for this single year? The fact that silver is still, even at $64, more than double where it began just 18 months ago. Your comment is not just a comment. It is a data point in a conversation about financial literacy that matters. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership questions so you can make your own decisions with your own money and your own risk in mind.